Hi, everybody, and welcome back to our last video in Chapter 11. This is a statement of stockholders' equity. Don't get that confused with a statement of retained earnings here. This has the full stockholders' equity listed. So it starts out with common stock, then it goes to paid-in capital in excess of par for that common stock, retained earnings, some treasury stock, and then a final total stockholders' equity column. For common stock, you see the beginning balance here. They've issued $1,000 worth, and that $1,000 considered was actually 11,000 with it paid in capital in excess of par here. But they started with a beginning balance of 20,000 in paid in capital in excess of par. So my totals for common stock are $3,000 and for paid in capital in excess of par, $30,000. Retained earnings is a very easy financial statement. We start with beginning retained earnings, we add net income, we subtract cash dividends, and in this case, it's ending balance of 72,000. Here we've issued $15,000 worth of treasury stock that did reduce our stockholders' equity by that 15,000. So we add across all the columns, and that totals $90,000 of ending total equity. All right, so now we'll get to the analytics of this chapter. These are important analytics from the standpoint of investors. And here we'll look at earnings per share, the price earnings ratio, and the dividend yield. All right, so when they talk about earnings per share, they're talking about the basic earnings per share. You'll see in some of the 10Ks for your project, you'll see something called fully diluted earnings per share. And what that means is that they pretend that all the possible stock options have been taken, and that will increase the amount of outstanding shares when that happens. And as a result, the fully diluted earnings per share will be somewhat less than the basic earnings per share. Normally, that's a very, very small difference. I don't even want you to think about that when you're doing your projects, but the basic earnings per share is what we'll worry about here. Now, normally, if I was saying earnings per share, you'd just say, hey, that's earnings divided by outstanding shares, which is kind of true. But here, it's slightly different. Here, we're going to take our earnings, net income, but we're going to back out preferred stock dividends. And the reason we do that is because those preferred stock dividends are not available to the common stockholders. So we're looking for a number that's for the common stockholders, not for the preferred stockholders. Now, this weighted average common shares outstanding, I could go through an example of that with you, but picture a year where you start with 20,000 shares and then you go to 30,000 in April and you go to 50,000 in September and maybe 55,000 in December. You would just basically do a weighted average of those common shares, and that's what you would use for that calculating the basic earnings per share. I hope you followed that. But that earnings per share is one of the most widely cited accounting statistics, and it's used extensively in valuing stock. This is not a course in finance or the stock market, but I just want you to know that earnings per share is very important. Now, the price earnings ratio, you need to have the earnings per share as the denominator here. So that is going to be the market price of that share of stock per share divided by the earnings per share. And this ratio reveals a great deal about the stock market's expectations for the company's future growth in earnings, dividends, and other opportunities. This is probably the most difficult metric to really fully understand when you're first starting out, but I'll give it a shot. Most compelling investment grade stocks probably have a price earnings ratio between 12, 13, 14, 15, 16, 17, something like that. And that says that's a good investment. But if you get into a stock like Nike or Apple, particularly, Apple's price earnings ratio is off the charts. I mean, last I looked at it, it's about 33, 34. It's awfully hard to make money on a stock that has that kind of bullish expectation for future growth. That means the stock price is way up there. And for it to go even further and make money by buying that stock becomes more difficult as that price earnings ratio increases. So hopefully you'll kind of get a feeling for that. If you've looked at as many stocks as I have, you kind of get a feeling for what's a compelling investment and what's not. And so I will leave that judgment to you and for future coursework. But the price earnings ratio, sometimes called the multiple, is a very important metric from the standpoint of stock investments. Dividend yield is an easy one to understand. Here, where it's like you're putting money in the bank. You buy a share of stock and you want some interest on that stock. And if you were to go down to the bank and the bank offers you 5% on your money, you put your $100 in and you get $5 every year thereafter. Now, this is the same thing with the dividend, except that you're buying stock. So what you do is you say, what's my annual cash dividends per share? And cash dividends are usually paid quarterly. So you have to add four numbers together to get that annual cash dividends per share. And then you divide that by the market value per share, that which you paid for that share. And that will give you your, call it interest. They call it dividend yield, but the same as if you went to a bank. Anyway, that's dividend yield. And for some investors who really buy their stock for dividends, a more conservative investor, not appreciation of stock, but for the dividends, that's an important measurement. All right, that ends chapter 11. And when we come back, we'll take a look at chapter 12. Until then, bye for now.